Most people believe that the gig economy has unlocked financial freedom. Drive your own car, work when you want, and get paid instantly. It sounds efficient, rational, even empowering. But behind these flexible hours and fast payouts lies a system that looks profitable only on the surface. The numbers tell a different story. While gig workers often see $1,200 to $1,500 a week hitting their apps, the majority end up earning less than a minimum wage once real costs are included. Let's look at the picture without romantic filters. An average Uber driver in a large city might gross around $25 an hour. That figure seems solid, comparable to entry-level white-collar jobs. But gross is not profit. After deducting fuel, $5 to $7 per hour, vehicle depreciation, 30 to 40 cents per mile, maintenance and tires, 10 to 15 cents per mile, and self-employment taxes, 15%, the effective net hourly rate drops to around $10 to $12 per hour. If you account for unpaid downtime, waiting for rides, cleaning the car, scheduling, real hourly income can approach $8 per hour, barely above US federal minimum wage. This gap exists because most people don't view this activity as a business operation. They think like employees. Hours worked equals income earned. Yet gig driving is not employment. It's micro-entrepreneurship with variable costs, assets, and liabilities. Without structured accounting, drivers unintentionally misprice their labor. They see $200 on a daily statement and feel successful, even though $80 of that is already committed to expenses they haven't recorded yet. Another illusion comes from the immediacy of cash flow. The Uber app shows constant earnings accumulation. Each trip adds visible progress. Psychologically, this reinforces the sense of productivity, but financially, it conceals delayed costs. Engine wear, tax obligations, insurance premiums, inflation. The income looks steady, while the capital base, the car, the driver's time, and physical health, is quietly depreciating. Consider one example. A driver earns $1,400 weekly before costs. Over 52 weeks, that's $72,800. In real terms, subtract $10,000 for gas, $6,000 for repairs and parts, $4,000 for tires and maintenance, $3,000 for insurance differential, and $10,000 in self-employment taxes. That leaves about $39,000, or roughly $18.50 per hour pre-depreciation. Once you include annual vehicle depreciation of $7,000 to $9,000, the total drops closer to $15 per hour. And that's assuming consistent demand and no downtime due to illness or car issues. Compared to a fixed salary job with benefits, this flexible freedom starts looking like an unstable trade-off. The underlying reason many drivers miss this reality is the lack of system thinking. The gig model is designed for short-term visibility, earnings today, payouts tomorrow, but hides long-term liabilities. It encourages volume over efficiency. Every additional ride feels like progress, while in reality, each mile driven erodes the main asset that makes the income possible. Over months, this pattern compounds into exhaustion, unplanned expenses, and zero capital accumulation. This is not a moral issue or a failure of hard work. It's a structural problem born from misaligned incentives. Platforms maximize trip volume, while individuals chase cash flow without tracking cost per hour or cost per mile. Over time, the illusion of flexibility becomes a financial treadmill. You're moving constantly, but not advancing economically. The question isn't whether driving for Uber is good or bad. The real question is, are you actually building wealth or just liquidating your assets, your car, your time, your health, for temporary income? The numbers suggest the latter. Understanding why this happens and how to reverse it requires shifting from effort-based to system-based financial thinking. That's where the real story begins. The financial problem behind gig work does not stem from low pay alone. It originates in the structure of how income is created and managed. Gig economy workers are participants in a decentralized labor system built for short-term efficiency, not long-term security. Platforms like Uber, DoorDash, and Bolt convert human labor into immediate output, but the financial flow remains fundamentally linear. Drivers generate value per hour, not per system. Once the labor stops, so does the revenue. That's not entrepreneurship. That's fragmented contracting without capital accumulation. Let's dissect the income structure. A gig worker's revenue depends on three factors: hours worked, demand volatility, and platform algorithms. Each of these factors is external. The worker controls effort, but not earnings per hour. This asymmetry creates a structural ceiling. Even with perfect discipline and maximum hours, output remains capped. There's no multiplier, no ownership component, and no scalable process. That is why long-term financial progress rarely occurs, because there's no compounding mechanism built into the model. Behavioral patterns intensify the issue. Most drivers treat daily earnings as accessible cash. There's rarely a formal ledger separating gross receipts from costs. Without accounting discipline, there's no visibility of real margins. Expenses get absorbed into life consumption. Fuel is paid with earnings, maintenance delayed until critical, taxes postponed until unavoidable. The result is financial confusion disguised as freedom. The individual believes they are self-employed, yet functions entirely as a reactive worker with no operational plan. Take a straightforward scenario. A driver named Alex earns $5,000 gross monthly from Uber, similar to many urban drivers working full-time. After all recurring costs, approximately $1,500 to $1,800 for fuel, maintenance, and depreciation, and estimated taxes around $700 to $900, the real take-home shrinks to around $2,400 to $2,600. However, because cash arrives daily, Alex perceives higher liquidity and adjusts living costs accordingly. Rent, groceries, and personal expenses expand to match perceived income. Within a year, the car requires major servicing or replacement costs, totaling $2,000 to $3,000. Since there's no reserve, Alex uses credit, leading to interest payments that wipe out an additional 5 to 10% of subsequent months' income. The pattern repeats until debt becomes normalized. The standard advice, drive during peak hours, earn bonuses, maximize ratings, fails because it only optimizes the top line, not the bottom line. The assumption behind such tips is that increasing gross revenue will improve net income. It doesn't, because cost scales with time and distance almost linearly. Driving 20% more hours rarely yields 20% more profit. It typically results in higher maintenance and fuel use that absorb any incremental gain. This makes traditional work harder strategies mathematically unsustainable. A second example illustrates the systemic side. A driver named Maria decides to switch platforms, hoping that better rates will improve her results. Her new app pays slightly more per mile, but includes longer idle periods between rides. Gas usage per job rises, net efficiency drops, and yet the psychological satisfaction increases because each ride feels more profitable. After 6 months, her yearly mileage is the same, but car value has fallen by another $5,000, and total savings remains zero. The structure, not the choice of platform, dictated the outcome. The deeper reason these patterns persist is the absence of a financial system. No tracking, no separation of funds, no forward budgeting. Gig work attracts individuals seeking flexibility, but flexibility without structure equals volatility. When every input, time, fuel, wear, produces a short-lived output, stability requires more than effort. It requires financial mechanics. Without introducing those mechanics, even high-performing drivers continue to misinterpret income as growth. The financial stagnation in gig work arises from three key mistakes that the majority of drivers make consistently. First, they fail to calculate and track true net profit per hour. Second, they do not separate operational costs from personal spending. Third, they treat labor income as a permanent asset without reinvestment. These are not moral failings or bad luck. They are logical errors in financial processing that compound over time. Mistake 1. Ignoring net profit calculation. Most drivers focus on gross fares, rarely subtracting depreciation or opportunity costs. A vehicle loses value at approximately 30 to 50 cents per mile driven. For someone logging 1,000 miles weekly, that's $300 to $500 in untracked loss. Over time, this turns a productive tool into a liability. Mistake 2. Commingling funds. Earnings land in a single account, and costs blend into lifestyle expenses. There's no buffer for maintenance or taxes, so cash shortages lead to high-interest borrowing. This behavior effectively reduces available income by 10 to 15% annually through debt servicing. Mistake 3. No reinvestment discipline. Without allocating a fixed percentage to savings or assets, all output gets consumed. Gig income lacks the automatic deductions, retirement, insurance that traditional jobs provide. Now consider the long-term consequences through simple projections. Assume two drivers start with identical conditions: $30,000 annual gross income, $15,000 in operating costs, and $4,500 in taxes, leaving $10,500 net annually if managed correctly. Scenario A. Typical driver. No tracking, no separation, no reinvestment. Year 1. Spends the full $10,500. Vehicle depreciates $6,000. Needs replacement after 5 years at full cost. Savings, $0. Year 5. Cumulative earnings $52,500, but $30,000 spent on vehicles and repairs, leaving no net gain. Year 10. $105,000 total earnings, but asset depletion and inflation erode purchasing power to effectively $70,000 in real terms. Year 20. $210,000 total, but continuous replacement cycles and no compounding means zero wealth accumulation. The driver remains at the starting point financially, despite 20 years of full-time work. Scenario B. Driver with basic corrections. Same income, but tracks costs. Net $10,500. Separates 30%, $3,150 per year, into savings/investments at 7% annual return, historical index fund average. Year 1. $3,150 saved. Year 5. $18,000 invested, grows to $21,500. Year 10. $31,500 invested, compounds to $47,000. Year 20. $63,000 invested, reaches $170,000. The difference isn't higher income. It's the decision to allocate output into a compounding system. These projections illustrate the core principle. The problem lies not in income levels, but in what happens to the income after it's earned. Gig workers often generate more gross revenue than minimum wage employees, yet end up with less wealth because their decisions prevent accumulation. Over 10 years, the typical driver's car becomes a repeated sink of $40,000 to $50,000 with nothing to show. The disciplined driver builds an asset base that generates returns independently of driving hours. At 20 years, the gap widens dramatically. Scenario A leaves the driver dependent on physical labor into their 50s or 60s, with health and market risks amplifying vulnerability. Scenario B creates a buffer that funds semi-retirement or diversification. This isn't speculation, it's arithmetic. Labor income without margin allocation guarantees erosion. Allocation builds position. The longer the horizon, the more punishing the unaddressed mistakes become. The issue remains structural. Even drivers earning $50,000 gross annually fall into the same trap without these corrections. Income is merely the input. Decisions determine the output. The solution requires treating gig driving as a business with a fixed financial processing system. This means implementing 3 core mechanics: precise cost tracking, automatic fund separation, and disciplined reinvestment. These steps convert variable income into predictable wealth accumulation without requiring higher earnings or lifestyle sacrifice. Mechanic 1. Calculate true net profit per hour. Start by building a weekly cost baseline specific to your operation. Track fuel at actual cost per mile, typically 0.15 to 0.25, depending on vehicle efficiency. Add depreciation using the IRS standard mileage rate of 67 cents per mile for 2025, which covers wear and value loss. Include insurance, maintenance, and platform fees. For a driver averaging 1,000 miles weekly at $25 gross per hour, total costs often reach $12 to $15 per hour. Subtract these from gross fares to get net profit, say $10 to $13 per hour. Use a free spreadsheet or app like QuickBooks Self-Employed to log every ride's revenue and mileage. This number becomes your real wage benchmark. If it falls below $15 net, reduce hours or optimize vehicle choice. Mechanic 2. Separate funds into dedicated accounts. Open 3 bank accounts: operations, taxes, and growth. Upon receiving weekly payouts, for example $1,200 gross, allocate immediately using fixed percentages based on your cost analysis. Assign 25 to 30% to taxes, covers federal, state, and self-employment tax at 15.3%. Deduct 40% for operations, fuel, maintenance, insurance. The remaining 30 to 35% splits between living expenses and growth. For $1,200 gross with $500 costs, this leaves $700 net, $175 to taxes, $210 to living, $315 to growth. Automation via bank transfers ensures compliance. This prevents the common error of treating all cash as spendable. Mechanic 3. Reinvest growth funds into compounding assets. Place the growth portion into low-cost index funds tracking the S&P 500. For example, Vanguard VOO or Fidelity FZROX, with expense ratios under 0.03%. These funds hold shares in 500 major U.S. companies and historically return 7 to 10% annually after inflation. No stock picking, no timing the market. At $300 monthly into such a fund, after 5 years at 7% compound growth, the balance reaches $21,000. After 10 years, $52,000. This creates income independent of driving hours. Why is this stable rather than risky? Index funds diversify across thousands of companies, reducing single stock volatility. Over 90% of professional fund managers fail to beat this benchmark long term, per S&P Dow Jones Indices data. The system relies on arithmetic, not speculation. Costs stay predictable through tracking, taxes get prepaid, and market returns average out over decades. Variability in gig income gets smoothed by fixed allocation rules. High weeks build the growth pot faster, low weeks preserve principal. A practical example. Driver earns $40,000 gross yearly, $20,000 costs, $6,000 taxes, true net $14,000. Without system, spends all, ends year at zero. With system, $4,200 to growth at 7% yields $290 first-year return, growing to $28,000 in 5 years. The logic holds because it prioritizes margin over gross and compounds output systematically. This isn't complex finance. It's basic business accounting applied to personal cash flow. Implementation takes 30 minutes weekly. The stability comes from rules, not willpower. Once set, the system runs independently of daily motivation or market swings. The complete financial system for gig workers consolidates into one repeatable process. Track costs precisely, separate funds automatically, and reinvest the growth portion into compounding assets. This formula, gross revenue minus costs, minus taxes, minus growth allocation, equals sustainable living income, transforms variable gig earnings into predictable wealth accumulation. Every dollar processed through this structure builds position over time, regardless of weekly fluctuations. Here's how the system operates in practice. Receive weekly payout, for example, $1,200 gross. Day 1. Log mileage, fuel, and fees to confirm $500 in costs, leaving $700 net. Day 2. Transfer fixed percentages, 25%, $175, to taxes account, 40%, $280, covers next week's operations, 10%, $70, to emergency reserves, and 25%, $175, to growth investments. Living expenses draw only from the remainder. Review monthly. If net hourly rate dips below $15, adjust hours or vehicle. This closed loop ensures every payout contributes to stability, not just survival. The outcomes scale predictably over time. Assume $40,000 annual gross, $20,000 costs, $6,000 taxes, leaving $14,000 net. Without system. $0 saved after year 1. Vehicle replaced at full cost every 5 years. Total wealth stays flat. With system, $3,500 annual growth allocation at 7% compound return. Year 1. $3,500 invested grows to $3,745. Living standards maintained. First vehicle replacement partially funded from reserves. Year 5. $17,500 invested compounds to $21,000. Emergency fund covers full car replacement. Net worth, $25,000 plus versus $0. Year 10. $35,000 invested reaches $52,000. Income diversification begins. Investments generate $3,600 annual passive return, covering 25% of living costs. Year 20. $70,000 invested grows to $170,000. Driving becomes optional. Passive income covers 75% of expenses. Financial independence achieved through arithmetic, not higher earnings. These projections use conservative math. Historical S&P 500 returns minus 3% inflation. No market timing required. The system compounds labor output into assets that work independently. Immediate action checklist. Start today. 1. Download mileage tracker. For example, Everlance, free tier. Log this week's rides. 2. Open 3 bank accounts. Operations, taxes, growth. Link auto transfers. 3. Calculate personal costs. Fuel per mile times weekly mileage plus insurance per maintenance equals baseline. 4. This week's payout. Allocate per formula above before any spending. 5. Invest growth funds into VOO or FZROX via Vanguard/Fidelity app. No minimums. 6. Set calendar reminder. Weekly review every Sunday, 15 minutes. Execution takes 30 minutes weekly after setup. Track progress quarterly against the 1/5/10-year benchmarks. Gig work presents real challenges, but they're structural, not insurmountable. Variable income becomes stable output when processed through fixed rules. Most drivers remain stuck because they measure activity instead of margins. This system reverses that logic. Every hour driven funds future independence, not just today's fuel. Applied consistently, it converts linear labor into compounding wealth. The choice rests on implementation, not circumstance. Start the allocations tomorrow. The numbers will handle the rest.